afternoon, everyone. We're back to Mondays with More. We are back to our costing unit on your level 2 qualifications, principles of costing. In the past, this used to be a part of your synoptic assessment as well. They used to be calling element of costing, ELCO. Now they just changed that elements to principles. It's like AAT just want to keep the name changed every time for some reason. When they change the curriculum, the name of the module also changes. So in this time they have gone to PCTN, but this time when the 2022 qualification came around, it came with an added the spreadsheet elements within this course. So whenever you're going to do these exams, there is an expectation students have to demonstrate basics spreadsheet skills. You don't need to be an advanced, like a Zen kind of a mind, like if I'm going to talk about Excel and stuff like that way, you don't have to be, but you need to know to distinguish yourself. Instead of typing the numbers as your answers, you have to put a formula. A formula is simple. How you do a formula, you're going to say A plus B is equal to C. So if they ask you to work out a particular number, you need to reference two cells, and then the output will be on that box there. So whenever you're going to do that, you'll be fine. You don't have to do any complex formula like VLOOKUPs or pivot table, pivot charts, conditional formatting, goal seek function. There's so much things there. If statements, those things are not for level 2. Those things are for level 3 when you get to the maths unit, which is the management accounting techniques unit. At level 2, the expectation is the students to have a basic understanding of spreadsheets, but it does not stop there. That should be their launch pads. By the time they reach level 3, they need to have some sort of an adequate understanding of how the spreadsheet work in accounting. And then also they need to be mastered at least the basic functions there. So the functions means like the sum functions, max function, average functions. Anything can be done with your normal common sense. Like if I say a sum function, it should add up a given list of cells or a range of cells. A max function, we should find out what is the maximum number on that given range of cells. Average should give you what is the average of given range of cells. So those kind of things you should be knowing by the end of this year. At least you need to find a way you can gather that knowledge by playing around with Excel. Most of the time, you should have an Excel available to you. If you're enrolled to a college, the college will give you the Excel as the, like sometimes like 1 year free trial. You'll be able to use that in your laptop. If you bought a laptop, sometimes you have that pre-installed in your computer. But if you don't have any of it, it's absolutely fine. Just go into the Google, log into your Google store. You can download the Google Sheets, I think they're free, comes with that Google as well. And it's also a spreadsheet, does almost the similar functions as your normal Excel, Microsoft Excel. So if you haven't got that, you can go for the alternative, but you need to start working on spreadsheet. You want to progress to the further higher levels. The expectations are also very high there when you reach there. So let's start this session without further ado. We are going to be doing two chapters. One of the chapters are to do with the material, how we value materials in the process, like in productions and everything. Then also we're going to look into budgets and variance. It should not take long, but it is very critical you understand what are the elements behind those two modules or the two chapters there. The first one is what is the thing we're going to do with the materials. So how are we going to value them, raw materials there. Sorry, what is that? Yeah. So why we value them? It is important to know, we need to know what is the cost of the material we send into the production and whatever left in the store at the end of a period. Because we have to remember the material we give out, it not necessarily is going to be all used. Sometimes some of the materials can be sent back to you. And also you have to remember the material doesn't cost you the same money every time, because you may have goods you received into your production, they're valued at different prices. So therefore, when I'm going to use that in production, I need to cost them appropriately to the value we actually paid for. Otherwise, there is no realistic way to understand how much a process will cost for you. So that is why it's important to value them while you using that in your production. So here, there are a few methods there. Hello, Penny. Say hi to my cat. She's here. Hello.
Oh, look at her.
She just sneaked into the room. I think she doesn't want to be here. Okay, you can go later. Let me open the door for you. Go, go, go. Otherwise, she'll be scratching the door there, so I don't want. All right, and so the few methods we know of how we value the inventory are FIFO, which is first in, first out. How it works, so if you receive 3 different inventories, one of them cost you £10 on the first day. The second day, I bought it for £12 a day, and then £14 if I bought that on the third day. So if I'm going to issue for production, I'm going to look at it. One of them was sent out on the first in, first out. We're going to send day 1 stock. This is what we use. And day 2 and the day 3 stock will stay as your closing inventory. The second method is last in, first out. So when you look at that here, we have the similar way. We don't issue any of the older stock. We issue the newer stock, which is the third day one, which is going to cost £14 on my cost card. So what is left on my inventory will be item 1, sorry, the day 1 item and the day 2 item. So therefore, there will be the older stock remaining in my closing inventory. And something in between both of them, we have something called the average cost. The average cost works out, we put them all together and we choose one randomly and we cost them all at same price. So therefore, if I'm going to look at it, an average cost will be, if you add these 3 and divide by 3, it will give you cost of 1 unit, which will be £12. So it could be anything. It could be 1, 2, or 3, but it does not matter how much we paid for it. We will just assume each one of them cost you an average of £12 there. So there is a kind of a conundrum. You look at it. If the value are completely increasing throughout, you need to remember the cost of issue on the FIFO will be the lowest amount and the closing inventory value is higher. But in the LIFO, it will be other way around. The cost of issue will be higher. The closing inventory value will be lower because we still have the older stock. And AVCO will be right in the middle of them too. It will be right in the middle of them too there. Now, let's look at the next one. What we talk about, inventory control. So how you control the inventory is by doing something called manufacturing accounts. And then also we learn about what is the meaning of holding inventory, why we hold the inventory, why we can order so much items, or shall I order more than what you expected, or shall I just be safe? For that one, sometimes you have to remember, do not over ordering it. Sometimes if you order too much, what other problems can happen? Because if you don't sell them on time, they can become possibly obsolete or even expire or completely deteriorate. So therefore, we have to be careful when we hold the inventory. We need to make sure there is enough inventory to run the business, not too little, not too much. So we will look into some of the inventory control methods. For that one, the words we use is one of them is a buffer inventory. What is the meaning of a buffer? Buffer is something like a safety net, or maybe something to go into, like in your car. When you drive your car, you normally put petrol or diesel on it. You normally have a fuel gauge there. Your fuel gauge is just whenever you fuel up, it goes up. When you're going to use your vehicle, it comes down. Your buffer inventory, you can think like that is the orange area where it comes, your fuel is get below a certain level, it goes into the reserve. But that time you have your alarm bells ringing because you don't want to run out of fuel, do you? So therefore, think like the buffer inventory is the absolute minimum you need to have just in case there is unfortunate circumstances can happen, like suddenly there is a strike or there is the national emergency for something. One of the courier's truck is broken down, so the delivery hasn't come on time. So you can dip into that buffer inventory, which you don't normally use. What is the reorder level? It's where you think you need to order your goods so that can be delivered to you on time so you can use it to your what do you call production. But you have to remember, not all the businesses have a delivery you can get it on the next day, because normally it doesn't always work like that, because you have to order them goods from somewhere in the globe. So you probably have to give something called a lead time for the time you order the goods and until you receive the goods. So therefore the reorder level is very important for the business, and also the reorder quantity, because you will order something which is allows you to replenish your stocks when you receive the stock, but you should not have reached the buffer inventory by that time. Reorder quantity is what you need to order to give your stock back to adequate levels. And the last one is called economic ordering quantity, EOQ. You will learn about that in level 3. The short and sweet one, this is a formula that allows you to order how many units you can order without having to overspend. That means you have to consider, when you go to order, you have to have a cost for ordering them, because you may have to have a delivery cost. You have to pay somebody, like fee for that one costing in that scenario. And also you have to remember, you have to look at the holding of your goods as well, because when you buy something, you have to keep in your warehouse. That's going to cost you. Why? Obviously the warehouse is not free, isn't it? So therefore it's something you have to take into consideration. We'll learn about that all in level 3. But what do you need to remember? Ensuring that the right quantity of the right quantity of the irrelevant inventory is available at the right time and the right place. This is the synopsis of inventory control. So let's have a quick look at some question there, which I have prepared so we can work on. Not this one. I don't need that. This is PC. Okay. So here we have some multiple choice questions. So let me come out of this so I can go into the spreadsheet now. Yeah, that's fine. That's cool. First question here. A company uses first in first out method to price issues of raw materials to production and values is closing inventory. So they're using the first in first out. They're asking you here, which one of the following statements best describes the first in first out method? Issues to production will be made from the newest inventory available. Is that the meaning of it? Remember, if you have the newest inventory, that is the last in. That is not FIFO. Issues of production will be made at the most recent prices. Again, that is going to be the newest means recent prices as well, isn't it? So that is again LIFO. Now the closing inventory will be made up of the most recent purchases. That means after I issue my stock, whatever's left over is my most recent purchases. Absolutely. When I'm doing FIFO, I'm only going to give my oldest purchases, not the recent purchases. So whatever it's left in my inventory, which is my closing inventory I'm talking about, it will be my recent purchases. So that is correct. FIFO is not acceptable by HMRC and IAS. That is categorically wrong. FIFO and AVCO are the only two methods accepted by HMRC and IAS too. Why? They return higher profit than LIFO. Therefore, HMRC and IAS2 are the only methods allowed to use in your financial statements. But LIFO, along with the other two methods, can be used for my internal calculations, for my internal budgeting, my internal plans. I can use those three methods. It's absolutely fine. But if you have to submit in a financial documentation when you value your inventory, you have to use either FIFO or AVCO. As per the guidance by HMRC and IAS2, which is the International Accounting Standards category 2 there. And then also you may get question like this, true or false. Issues of inventory using FIFO are valued the most recent purchase prices. So again, see, when you see a question like that way, I would sometimes create some sort of the writing. So I will say here, these are my issues. So receipts. So I'm saying receipts A, B, C. So these in the order, they are the one we are going to receive. So if I'm going to use a certain methods, for example, if I use FIFO, so I'll have issues, closing inventory. I'll write it down like that way. So if I'm going to issue, what I'm going to issue first, I'm going to issue A first, then the B after that. And what will be my closing inventory is going to be C. Now, if I'm using LIFO method, what is the first one? First will be C, and the one after will be B. What is left on my closing inventory will be A. If I'm doing AVCO, I have an average of ABC, and whatever left over is also an average of ABC. We put them like that way. So let's look at the first statement. Issues of inventory using FIFO valued the most recent purchase prices. So the issue, which one is the most recent purchase prices, is C. Is it true? That statement is wrong. So in this scenario, the issues of inventory, we use the oldest purchase prices, not the recent purchase prices. And the closing inventory valued at the oldest purchase prices and AVCO. Straight away, there is a quick remedy for this. When you hear AVCO, if you don't see the word average in your statement, that statement is also wrong, because closing inventory valued at the oldest purchase prices. Which one is the oldest purchase prices? That is going to be LIFO, but it does not have the word average here. So that cannot be AVCO. So these statements, both of them are false. So now let's look at some questions here. So they have given you one here like that way. Identify which inventory valuation method is being used in the following situation. So whenever you get a question, I always ask myself, okay, did they ask you to do the calculation there? No, they only want to know what method has been used. So let's see here. Initially, they have 100 units. 20 pounds a unit they paid. It's altogether 2,000. So they received another further 150 units. Is 25 pounds a pop, is 3,750. So the total inventory now is 250, valued at 5,750. Because can you see here, if you add this plus that, that gives you 5,750. Now they issued 180 items, and the total value pegged us at 4,350. But let's see which method that could be. So if I'm going to use FIFO method, I'll show you how I'm going to be approaching this. So here I'm going to say FIFO. Then I'm going to say this is my issues, my closing inventory. I need 180 items. I need whole of the 100 from this stock. Why? Because that is my first in, first out. So I need all of that. And how many more I need? I need another 80 more. I'm going to dip into this 150 items, and I'll take 80 from there. But they are 25 pounds each. So that is going to be equal to that times 25. So that will be altogether equal to 4,000 pounds. So if I'm going to look at the value of the issue is 4,000 pounds, it does not have that number there. So it cannot be FIFO. But let's look at the closing inventory as well. How much we have there? We have 70 left, and that 70 should be equal to that times 25, because that's what's left over, isn't it? So that is 1,750. So these two numbers are not matching. So this is 180 items and is for 4,000. 70 items at 1,750. It's definitely not FIFO. Let's say, is it going to be LIFO? So if I'm going to using your LIFO method, I need to go from down upwards. So that means I need to take the 150 items first, and that is going to be 3,750. Is it enough? No, I need 30 more, 30 items, and they are going to cost you 30 times 20 pounds. So that is going to be 600 pounds there. Altogether, if I'm going to add these two numbers, and I'm going to get 4,350 for 180. So can you see that here? That is matching. Let's prove what is left over. We have 70 items left over, and they all cost you how much? 20 times. That's 70 there. That's 1,400. So these two are actually matching these two numbers. Therefore, this method is used is LIFO. In case if you want to know about AVCO, let's quickly look at AVCO. If I'm doing AVCO, all I need to do is I need to find 180 items of the average of all of that. So what we have here, we need to find what is the average cost of each item. So if I'm going to say here equal to the total cost of 5,750 divided by 180, not 180, apologies, 250 units, it gives you an average value of 23 pounds. So therefore, if I'm going to issue that many items, 180 items, this is going to be that times the 180 units. So it's going to be 4,180. And then how much is left over there? We have left over 70 items, and that is going to be equal to that times 70 units, 1,610. But let me tell you also another quick, if you add these two numbers, it should be the amount what you had before we started the issues. That means my inventory was 5,750. Here you go. If you add these two also, you get the same number. If you add these two numbers also, you get the same number there. So in case you made a mistake, just remember to go back and check this, whether this is correct. The value of your issue and the closing inventory should be equal to each other, because on the next question, that is going to be something you need to be concerned about. The reason why, if you notice that here, we have got stock here. They want you to find the value of these numbers, but there is a cause for concern. We also received something after the fact we issued 400 units. So let's have a look at how we're going to do this question. So here I need 400 units. I'm going to use the FIFO method. Okay, so if I'm using the FIFO method, I'm going to use 400 units here. I will do proactively here a subtotal. A subtotal allows you to give you some sort of an idea of how much inventory I had at that point and how much it cost me altogether, the total value. Those two numbers are going to be very helpful for you. So what I'm going to do here, I'm going to quickly do this sigma function. And what it does, it just works out the number above. You don't need to do that in your exam though. It's just a way to remember. It's a method. If you click on this box and that box, if you press sigma button, that is basically an auto sum. Means it calculates whatever above there. So also I'll have here another sigma, but this time I only need these two numbers because I need that number for my final calculation. So therefore, I will have these two numbers ready for me. Yep. So I have a couple of subtotals, but all I need to do is first to find out how much is the cost of the issue on the 20th of June and what is the value of my closing inventory on 30th of June. So that day, if I'm going to issue 400 units, I'm going to take it out of the 500 units I have on that point. But which order I'm going to do that? So let's say here, issues, closing, inventory. So let's do the FIFO method. So if I'm doing FIFO method, I need 400 units where I'm going to take that from. First, I'm going to take the 100 units. Then I need to have 150 units. But is it still enough? No, and I need a further 50 units from that lot. Because if you notice that here now, no, not further 50, I need further 150. So that means altogether that is equal to 400. So if I do a sum function, here you go, it's going to tell me I have 400 now. So I need to find out how much is the value of all. Sometimes in this scenario, it's good if you also calculate something else. That is the cost per unit. So here in this scenario, I'm going to quickly find the cost per unit because that helps you with all the calculations later on. You don't have to do that like that way in this exam, but I'm just saying it does help you overall. So here, each one of that cost you £4. This one cost you £5 each, and this one is £5.50 each. And then let's look at The last one, their cost is £6 each. Okay, so now I'm going to put that same numbers there. So I know here I need 400. This is 750, but this time I'm going to use the number I have calculated earlier to calculate what is the value of the inventory. So I'm going to multiply this by £5.50 because that's what each one of them cost them, isn't it? So here I have all of that value of my inventory here and total it. It comes to 1,975. So that is the value of the inventory when we issued it using the FIFO method. But what is the closing inventory I have? Do I have anything from this 100? That is gone. That 100 is finished. So let me quickly show a different color here. I will say depleted. So that is depleted. Do I have anything in there? That is still, it's all gone. Do I have anything from there? I have some left. How many items left there? 100 of them left. And that is going to be costing you £5.50 each. Is that all the closing inventory you have? Now you have accounted for 400, which is issued, 100 of my closing inventory, which is that level. But they're asking you the closing inventory on the 30th of June. So please remember that number also needs to be added here because on that day we had this stock as well. So here 200 items at £1,200. Now what is the leftover stock in that case? If you sum it, it's going to be giving me £1,750. Now let's go back to my original calculation. And I have told you that number, like here previously, this number 5,750 like that way, in this calculation, this is the value of the inventory I purchased. So whatever I issued after that, whatever the stock is left over, add them together, you should have the same number. So here I'm going to say auto sum of these two. Here you go, 3,725. So that number has been achieved. So that means we haven't missed anything by accident. Now let's look at the next method. We use the LIFO method. So if I'm using LIFO method, which way we're going to do? We're going to do from bottom upwards. So that means the lower or the later stock and all the way up. But in this scenario, the student makes a cardinal sense. They normally take this into consideration when you come to issues. It is virtually impossible. Why? The stock was issued on 20th of June. You didn't receive this stock until 25th of June. So it is virtually impossible, isn't it? Therefore, you have to be very careful. Do not use that number for your inventory valuation. You can use it for your closing inventory instead. So here we need altogether how much? So let me just clear this color. I don't need any of it. No fill. So I need to have 400. Where I'm going to take from? I'm going to take 250. Is it enough? It's not. I need another 150 more, which gives you these two. So that means both of them are now completely depleted. So we used 400 stock, each of them valued here 1,375, 750. Therefore, I'm going to quickly check this 400 units. It valued at £2,125. What is left over on that time? Do we have anything of these two? No, they're both been depleted, but this stock is still there. 100, 400 pounds. And then also what we have 200 at 1,200 pounds. So let's see these two numbers here. Altogether 300 stock left, and they were valued at 1,600. Now let's see that here. If I do a formula, this plus this, I'm getting the same 3,725. So we haven't lost any value there, means we calculated everything absolutely perfect. And the last one is the AFCO method. So when I'm going doing the AFCO method, what do you need to remember? The average cost is calculated at this level. So here is where my cost has to be calculated on the average, not including this. Why? Because this wasn't there. So there's no reason I need to add it when I'm going to issue the units on the 20th of June, because It could be any price. So we can't hypothetically think this should be part of my calculation. So what is my average cost on that time? The average cost is going to be this divided by that number. So it tells you each one of that inventory will cost you £5.05. So therefore, if I want to issue 400 units, this times 400 units, and this is the value of inventory 2020. And what is left over? You have another 100 left over, isn't it? So if you have 100 left over on that time, the value of that inventory will be that times the 100 is 505. Also remember, we have the 200 which cost you 1,200. Make sure, do not forget that bit there. So let's add them on. It gives you 1,705 pounds. Now, can you see here, did I lose any value? So here, this plus that, it gives you 3,725 pounds. So this way, we are completely checking everything one by one, and we're making sure my closing inventory has not lost any values, because we simply cannot ignore that on your closing inventory. But this cannot be used in your issues calculation. So when you're going to issue the stock, these stocks are physically not there, therefore not part of your calculation. But when you come to the closing inventory, it is. So similarly, we have this question as well. They've given this like that way. So they're saying here 100 kilograms purchased at pound per kilogram. So it's the same thing. So if we have to look at it as this one is 1,000 pounds. And then we have next one is going to be equal to 180 times 11. Then that is the amount of it cost you. Then can you see that here price is fluctuating? 180 times £10.50. So we have a different price now. And then they issued 250 kilograms. And then the last but the least, we also have received some more stock. So let's see. Yeah. Delete. So we have the number now for the last one is 120 times 12 kilos, 1,440. So these are the stocks we have received. This is the total value of my inventory here. So let's do a quick subtotal here, subtotal there. And then here also I have another subtotal, this plus that is the final total. So here, let me underline this, one underline, and this one with a double underline. So here, this is the subtotal now. Yeah, so there is two totals there. Okay, so what we now have to do, we have to assume the same idea. So let's do here, if I'm doing 5-4, I need 250 kilograms. So where I'm going to take it from? So I'm going to take 100 kilograms from here, and then another 150 kilograms from the 11th of September one. So here I have 1,000 pounds, and then also 150 kilograms times the 11 pounds. So altogether, the value of my inventory is going to be equal to this plus that. So 2,650 pounds. But you also have to remember, you already knew there is a trick which I showed you. This minus that will be your closing inventory. Why? Because that's what it is. Your inventory at that point valued at 4,870 pounds. So if you know that one number, you already know that number. This minus that should give you the closing inventory. But you also have to remember, you need to add this back on. Or you could use that instead. Just this number minus that will be the closing inventory. But let's prove it. Let's prove it quickly. What is the closing inventory in this scenario? The closing inventory is, do I have anything from this 100 kilogram? No. Do I have anything from this 180 kilogram? Yes. We only spend 150 kilograms, 30 kilograms left. So equal to 30 kilograms times 11 pound a kilo. And then also we have all of this other inventory, which is 180 times £10.50, and then also the newer inventory of 120 kilograms times 12. Altogether, we have 3,660. So let's say here, if I use the way I've told you, if you know you've done everything perfectly, this minus that number, it gives you the closing inventory. Can you see that here? If you already done this, if you're very good with your numbers, you don't have to go through this painstaking calculation of your closing inventory. You only need to do calculate the cost of inventory, which is this, and then from that total value of the inventory, take away the cost of the issues, you'll have the closing inventory there. That is a trick for the students who have mastered the first method already. You can do this way. It saves you a bit of a time, but I will not recommend this if you're not sure about how you get the numbers. You need to go through the long way, the way I have done it. Okay, so just be careful with that, guys. Now let's look at the LIFO method. So if I'm going to look at the LIFO method, what we have to think, we take the stock from the 180 kilograms on the 13th of September first, because that is the only available there. You don't have the 25th of September available to you yet, have you? So let's take 180 kilograms at £10.50. And then also I need another further 70 kilograms. 70 kilograms times the £11 a kilo. So altogether, the value of my inventory will be this plus that is equal to £2,660. Now, what is the closing inventory for me in this scenario? If I done my own way of doing it, this minus that should be that. So it is going to be that amount. Let's prove it. Let's see here what's left. Do I have anything of the 100 kilograms? Yes, we haven't touched that yet. Okay. So the next one is how much left on this 180 kilograms. We have 110 kilograms left because we used 70, didn't we? So 110 kilograms times the 11 pounds, which is going to be 1210. And then the last but the least, we have 1,440. Remember that number? This is the number we had afterwards. So let's do a sigma of these numbers. 3,650. Can you see that number? I already got that number beforehand. So if you're very good with it, why not use it? I'll always recommend the students to be a bit cleverer. Just saves you a bit of a time if you want to, but end of the day, if you're happy with that, please use that method. The last one is the AVCO method. So again, for the AVCO, one thing I need is the average. I need to know how much I have in my my stock. So here I need to know what is the kilograms, how many kilograms I had. That way I can probably do this way. Yeah. So how many kilograms of stock I had when I issued this 250 kilograms. So I need to know that. So for that one, I'll have 100 kilos plus 180 plus 180. It's 460. Okay. So let's say here 460 kilograms altogether valued at 4,870. Let's find out value of 1 kilogram. So this divide by that. It should give you a value of 1 kilogram. It is coming to that decimal. It could be more decimals there. So let me increase it. Yeah, it has loads of decimals there. When you get this decimals, please do not worry about it. Use the same number to multiply the value of the inventory. So here, the value of the inventory is going to be that times 250 kilograms. So here that is going to be equal to that times 250 kilos. So altogether that comes up to what is that? 2,646 pounds 74 pence. Let's put them into 0 decimals. So I'll have 2647. And what is left over now? Remember, which I told you already, if you use this method, this number minus that number, it should give you the closing inventory value. But let's prove it as well again. So what was left over? I have 250 kilos used of that. So we have 210 left over, isn't it? So 210 times that number, it gives you 222326. Let's get rid of the decimals. And then you also have to remember 1440. This is what we left over. So add them and you will have 3663, and you have the number there again. So this is the final way of doing it, because this can be your lifesaver. If you know how to deal with that numbers, use this to calculate your cost of issues, and then when you have the total value of the inventory, minus it from there, you will have the closing inventory value. This way I have proved all of that number. They all work absolutely fine. So now let's look at the next one. It is going to be the manufacturing accounting. So here on the manufacturing accounting, the important part is to remember there are 5 steps. So let's quickly go into that slide, shall we? So here the steps are, the first thing they do is to calculate the raw materials, and then they will add direct labor to it to get the direct cost. And then we add any manufacturing overheads to that one, you get the manufacturing cost. And finally to that one, you reconcile your work in progress. Your work in progress is what you start with, means whatever you not completed it. And that one, you may have something from the previous period. So you add that to that cost of the value of the work in progress. But if you have anything at the end of your period, any new work in progress which are not completed, you get taken away. It's always a case of opening inventory of anything gets added to the cost, and any closing inventory of anything it's not completed, it's going to be taken away. So here for the raw materials, any closing inventory of raw materials, taken away. Any closing inventory of work in progress, taken away. Any closing inventory to that one, you reconcile any finished goods, because you may have in your stock some finished goods from the previous period. You add them to this period because they're part of the cost when you're going to sell them. But if you have any closing inventory of finished goods at the end of a period, you take them away as well. Why? They're not sold. Therefore, they're not part of the cost. So that is why the cost of goods sold, it's going to be finally attained. So can you see here? There are 14 lines there. But what you need to remember, though, is the 5 steps. First is your direct material used, direct cost, manufacturing cost, cost of goods manufactured, and cost of goods sold. So let's have a quick look at that, shall we? The question, here you go, there's a question. So they're asking you here, they're giving you some numbers and you have to redraft it. In the exam, they used to give like that way. Now they have changed it. I'll go through that in a minute. So let's start with it. We start with opening inventory of raw materials. So let's see here. Can I see the opening inventory of raw materials? Yes, I have that. First line. So I'm going to paste it here. The next one, it is purchase of raw materials. So we add that purchase of raw materials there. And what we need to do, the closing inventory of raw materials. So this one gets taken away. So what we'll do, we'll put a negative sign on it. So now what we get, the direct material use. Can you see here? They already given the number now. Can you prove it? Look at that here. Add these two, take that away, you get that number. In the Excel, on the spreadsheet questions, they give you one like that way. You need to do a formula. So if they got that here as 10,000 without a negative, the formula will be this plus this minus that number. That should give you 30,000. See, you got that number there now. Now the next one is they ask you to find the prime cost, but for that one you need the direct labor. So if I'm going to put the direct labor, I need to find what is my prime cost. What is the formula will be? This is going to be this plus that number is 55,000 pounds. So to that one, we add any manufacturing overheads. So can you see here we have the manufacturing overhead. They're asking you to calculate the manufacturing cost. Third step, what is that we're going to do? This plus that. That is your manufacturing cost. Then we're going to reconcile the work in progress. So we're going to look at the opening inventory of work in progress. We'll put it here. And then what is the closing inventory of work in progress? Where are you? There you go. We found that as well. So what we're going to do, this now, we will get a one called cost of goods manufactured. So here, in this scenario, that is going to be this plus that minus the closing inventory. Remember, the closing inventory always get taken away. So that is 74,000 pounds. Finally, we got to the final step, which is going to be the goods completed. So here, the opening inventory of finished goods, see, that's here. And then the closing inventory of finished goods, see, that goes here. And then finally, we have the cost of goods sold. So let's find out how much the COGS will be. So that is going to be this plus that minus the closing inventory. And that gives you 75,000 pounds. So that is one type of question here. And this is a second type of question. Sometimes they give you like this way. So let's make it full screen so you get a bit of a chance to see all of it. Yeah, here you go. So here they have a question like that way. They're asking you, what are these 5 steps there? So here, the only thing you have to be concerned about, this is not the part of the 5 steps. Can you see here? Manufacturing overhead is not the 5 steps here. So these are the 5 steps. 1, 2, 3, 4. They're in capitals as well. So here, if I'm going to do that, I will normally put them into this color because these are the 5 steps. But here, they put the manufacturing overheads. The simple reason, because what is the cost involved there? So they're asking you, what is the direct material cost? What I know now, the material forming the part of the product, this is 66,000. This is what we purchased. We started with 6,000. We closed with 7,000. We also purchased 66,000. So how I'm going to do it? 6,000 plus 66,000. 66,000 minus the 7,000 closing inventory, which is giving you 65,000 pounds material cost. So what is the direct cost to it? So direct cost will be this plus any direct labor. So which one of this here is direct labor? Is only this 57,000 pounds. It is nothing else there, isn't it? Direct labor is the one you used in production. So what about these? The material not forming the part of the product and the labor work supposed to be something, addition to the production, like a supporting worker, like a cleaner, a supervisor or something like that way. They're going to be part of your manufacturing overhead. So that's why they gave you that info there. What is your manufacturing overhead? Indirect materials, indirect labor, and the other indirect factory expenses. So if you have insurance, gas and electricity, the rent, they all will be as a factory indirect expenses. So here, the manufacturing cost in that case, all of that here added together now. So this is my direct cost plus the manufacturing overheads. It's 205,900. Now they ask you the cost of goods manufactured. What do you know already? You have the opening and the closing inventory of the work in progress. So let's say here the manufacturing cost plus the opening inventory of work in progress minus the opening inventory of work in progress. You get that number there. Finally, one more here. And then that is to do with that number plus any finished goods, which is 17,500 minus 19,500 is the closing finishing goods. And you get that number. So can you see here? We got 1, 2, 3, 4, 5 steps barring this. Okay, so if I hide that one and everything else are the 5 steps you have learned already. Now, without further ado, let's go into the next section of it we have to do today, which is the budgets. So why we do the budget? Saying here, we have to use that for your planning, control. You communicate with your workers, your managers, your supervisors. That allows them to coordinate to achieve the desired effect of a business. Because no business succeeds without properly setting themselves a target. That way they will be productive so they can evaluate when the real thing happens. So you put something on play and you compare what is left after that, what have really happened, and that allows them to look into that in further details and see whether they can improve on what they achieved, or also reflect on what went wrong and how to avoid that from happening on future. So that also can use as a motivational tool for the people involved in there. So there are the budgets they're saying here. One of them is a fixed budget. Fixed budget, it's something does not change. It's for one single activity level. They give you a budget, that's it. But a flex budget is they recognize the cost behaviors patterns. The budget changes as the volume of activity changes. That means you can have a budget for 4,000 items, but if you want 5,000 items, you can't have the same amount of budgeted amount. The budgeted amount has to change with the cost behavior. Remember, you learned about them. The cost behaviors are variable, semi-variable, fixed. Those things has to be considered so you can have an adjusted budget. So we call that a flexible budget. There is a third type of budget. They call it rolling budget. It just changes to period, like how the government does their fiscal budget, because they start, releasing a statement, summer statement, then an autumn statement, a winter statement, and a spring statement. That means the budget keeps on rolling. They just keep on tack on all the deficits. They just put more austerity on people. That's all it is. That's how the rolling budget works. So here we look at that, then we're looking at something called the variances. Variances is the difference between actual results and the budget. A positive variance and a negative variance, they can be classed. One of them is an adverse. That means it's bad for you. That means if you look at your revenue or cost, it's different to both of them. If you have a budgeted revenue and if you earn less revenue than that, it is going to be adverse, because you budgeted for £10,000 and you earn only £9,000 is an adverse variance. But what if you earned more? If you have 11,000 actual revenue instead of 10,000 budgeted, that means it's going to be a favorable variance. Can you see here? Adverse variance decreases the profit. Favorable variance increases the profit. So that is the underlying fact behind it. So then what we do, we look at it in the variances. We don't have to investigate all the variances. Why? Some of the variance can be trivial, can be like only small amount. So what the businesses do, they will set a criteria on whether a variance is large enough for report and investigate. That means you can actually spend some human resources on it. That's what we call an exception reporting. So therefore, an example of it can be sometimes if you look at the variances, they give a percentage. If the variance is 5% more than the budgeted amount, or more, 5 or more, then we'll investigate it. Otherwise, we won't. Or they'll give you a set amount, like, oh, if the variance is more than 500 quid, I'm going to look into that one. So that is the way they do it. How to calculate the percentage? The formula is the variance percentage is equal to variance divided by budgeted figure times 100. So let's look at some of those questions, shall we? I have a couple of questions we can work on, and we can call it a day after that. Okay. So and then also there is a MCQ question about the inventory valuation, inventory management, how we manage the inventory, like inventory controls. A company has the inventory control policy that ensures it never runs out of inventory, but also does not hold any more inventory than is necessary. Identify whether it's complying with its policy of considering whether each one of the statements are true or false. This is a very good like a true or false question. First one is the buffer inventory is the level of inventory that has to be reached before a new order is placed. So remember, is it where you want to reach the buffer inventory? No. Buffer inventory is absolute minimum. That means you don't order when you reach the buffer inventory. You reorder when you are in the reorder level, which is slightly higher or a lot higher than the buffer inventory. Buffer inventory is your reserve. You don't go in there. So therefore, that statement is false. What is the next one? Lead time is the time it will take up to use up the buffer inventory. It is not. You don't want to use up the buffer inventory. It is the time it takes for you to get your order delivered to you from the time of ordering. So that is what is your lead timing. So again, that statement is false. If the prices of the raw materials are rising fast, it makes sense to wait until last minute before placing an order. Again, that is not right, isn't it? If the prices are rising fast, you want to wait until last minute to place an order? That makes no sense. Because normally, if you remember, if the fuel prices are going up, do you wait until last minute to go to the petrol station? Or would you queue up now to fuel up as quickly as possible? Think about the world life. Yeah. Use that your own analogy. That statement is also wrong. Reorder level is the level of inventory at which it is the time to place a new order. Absolutely. That statement is perfect. Last one, sufficient inventory should always be ordered to fill up all the available storage spaces. Is that viable for a business? Can you see that word here? Always. The key word here, always. What is the problem if I do that all the time? If I use all my storage spaces, one thing is I need to make sure I sell them quickly. Second thing is it's going to cost me to hold them as well. So is it wise to do that all the time? No. You could do that when there is a high demand, then you want to use all your spaces up is fine. But it is not true for all the situations. So that statement is categorically wrong. You can't do that always. The word always mooted, this statement as completely wrong. So therefore, only statement D is correct. Everything else is false. Now let's look at the budget now without further ado. So here they have given you Lincoln Limited has produced the performance report detailing budgets and the actual income and cost for the last month. Let me get rid of the slides. We don't need the slides anymore. Yeah, so here, so I can see the bottom part of the screen. Calculate the amount of variances for revenue and each cost type, then determine whether it is going to be adverse or favorable. So if I'm going to look at that, if I ever get this question, the first thing I ask myself, if that comes on a spreadsheet, how would you do it? Okay, so you have to be careful with that. So here, I would like to do the variance as a positive variance as a positive number, or means the favorable variance, and adverse variance as a negative. So what I need to do is I have to do a formula to identify whether I'm going to get a negative number. It was an adverse variance. Remember, revenue and costs are other way around. So here, which one's supposed to be better for you? If your budget or actual? If your budget is bigger than your actual, that means you haven't done well because you budgeted for 145K, but you only have 142.5K, which is not good enough. So this is an adverse variance. So to get a negative number, you have to say actual minus budget. You get that minus 2,500 there. So this will be a adverse variance. But let's say about that for materials. If you have budgeted for 41,200, you actually spend 39,200 pounds. Is it good or bad for you? What do you think? It is actually good because you spend less. Imagine you budgeted for your holidays, you want to spend this much money, but end of the day, you're doing your calculations. You found, oh, I haven't paid that much. Are you going to be happy or not? You are going to be happy. In this scenario, it's the other way around. Can you remember the previous one? I have used actual minus budget for the revenue, but for the cost is budget minus actual. The formula changes to budget minus actual. That means if you spend less, you're going to get a positive number than your budget. So in this scenario, I can copy all of this formula straight away. All four of them are cost. So can you see here? Is that a favorable variance? This is a favorable variance. This is an adverse variance. Adverse variance. This is a favorable variance. Adverse variance. Can you see that here? This is how you do. You need to check which way it is. In the exam, they may ask you to type that adverse or favorable or A or an F on it, or you may have to choose a tick box. I'm not sure. I can't remember how was the exam. You will be able to see the mock exams I have done on YouTube. If you go to my channel, once you see the videos there, you'll be able to click on the courses, which is the level 2 certificate in accounting course, and you can see my walkthroughs of both PCTN exams there, and I have clearly explained to you how if you have to deal with it if there's a spreadsheet question. There may be some one question that I've made like similar small mistake with the decimals, but far from that, it should be absolutely fine. Now let's look at the next one here. This scenario, they give you the following performance report for another month has been produced by Lincoln Limited. Any variances excess of 5% of the budget means it needs to be more than 5%. It needs to be significant and it should be reported to the relevant manager for review and appropriate action. Calculate the percentage variances to 2 decimal places in the table below and indicate whether they are significant or non-significant by putting S or NS, means significant or non-significant, in the final column. So here, how to calculate the variance? Remember, variance is calculated percentage. This divide by the budget. So here, this one is going to be equal to that number divide by that number, and that is that one here. But you want to change that to a percentage? Change that using the percentage here. So it wants to be in 2 decimals as well. So let's increase the decimals. It is 0.18 percentage. Is that going to be any significant? No, it has to be 5% above that one. So this is going to be a non-significant. Let's do that formula again here. This is going to be this divide by that number. Enter. You have that number. Change to a decimals. 2 decimals. Can you see here? Is it more than 5%? Yes. So therefore is significant. So let's copy this all the way. Can you see that here? That is non-significant because it's less than 5%. That is non-significant. It's still less than 5%, but this is significant. So therefore, only the direct materials adverse variance and then a non-production overhead favorable variance are the only 2 are significant because they're more than 5%. So people may ask me, okay, I can see the point of investigating adverse variances. Why you want to investigate favorable variances? Aren't you happy you've done well? People do ask that question, but the reason behind it, the businesses want to learn why they did wrong. Also, they want to know why they did right. How did they do it? Can they use the same method for the future plans? Can they use that to different departments? So they also have that vested interest in good things as well, not just the bad things. The good things also gives you more, what is that again? Impetus for the business to strive for a better outcome. So therefore, they also investigate a good variance, means a favorable variance. Now let's look at the last question, shall we? So here, this is a very stretch question though, so I'll have about 10 minutes for this. Flights Limited has just reviewed its forecast for the number of miles it expects. Second, please. Expects to fly during the next month on a particular charter contract. Originally, it expected the contract would be for flight totaling 4,000 miles. Flight Limited now expects that the total miles will be flown will increase to neither 6,000 or 8,000 miles. Landing and fees are semi-variable cost. There is a fixed charge of £50,000 plus £40 per mile flown. So you have to remember, one of them is going to be a semi-variable cost. They're asking you to do complete the table below to calculate the estimated profit for the mile per profit per mile flown on the different activity levels. So what we're going to do now here, we need to know how to fill out the rest of the boxes. So let's say here, what is the total cost? The total cost is going to be this plus that plus that. These are all your costs. Fuel and other variable cost, landing and servicing fee, plus the fixed cost, all of them together to 1.918 million. So it's going to be the profit for the company, this minus that. It gives you £82,000 profit. So the profit per mile is going to be equal to the total profit divided by 4,000 miles they're going to fly. it's 21 pounds, but they want that into 2 decimal places. So you want the profit into 2 decimal places. So increase the decimal, it gives you £20.50 now. So you see, if I didn't do that, it will not give me the decimal places. Now, the next one is the 6,000 level. What happens when you fly for 6,000 miles instead of 4,000 miles? What will happen to your sales revenue? It is going to increase, isn't it? Because if you're going to have that much, the miles per charge is going to be equal to that times divide by that. It's going to be 500 pounds, because I'm going to get a revenue of 500 pounds per mile sales revenue. So therefore, how much is that going to be for this? So this is going to be equal to this divide by that times that, which give you 3 million. See, it is just increasing that way. And then same for this, divide by that times that number, he gives you that. So can you notice there is pattern? That is a variable cost. Give me 1 second, please, guys. So what is the variable cost does? If your activity increases, variable cost also increases the same fold. So if I'm going to say here, it's 428,000 pounds, it increases by that amount, like 50%. This also should increase by 50%, but let's prove it. So here, divide by that times that number. It will increase by 50%. See that another 214,000 pounds added on, and same again here, this divide by that times the number. So 856,000 pounds, basically it's doubled. But now we already know the landing and servicing fee is a semi-variable cost. So that means for 50,000 pounds fixed charge plus 40 pounds per mile flown. So let's prove it. They got that number right here. So if I'm going to see that here, 50,000, so 500,000 plus that number times 40 pounds per mile, 660,000 pounds. So I can do the same formula here again. So that means 500,000 pounds plus that miles times 40 pounds, and that gives you 740,000 pounds. Now let's look at that next one. 500,000 pounds plus 8,000 miles times 40 pounds times 40 pounds. So that gives you 820,000. Can you see here? There is a fixed element and a variable element to it. Can you see that here? There is a fixed element of 50,000 pounds, sorry, 500,000 pounds, and a variable element of 40 pounds per mile flown. So the more mile they flow, they will still have that £500,000 as my fixed charge. And the more you use, more charge you're going to pay towards that landing and servicing fees. Remember, that should remind you of your electric bill, your gas bill, because you have a fixed standing charge. More units you use, you end up paying more there. But the standing charge is fixed. You will pay regardless of you use any electric equipment or not. But what happened to the fixed cost? You know for a fact, fixed cost itself, it is fixed. It does not change. So therefore, that numbers are absolutely non-changeable. So let's look at the cost now. What is the cost? Cost is going to be all three of these numbers added together, and same here as well. These three numbers added together. So here your revenue is 3 million. There it's 2.212 million. Here your revenue is 4 million, and your total cost is 2.506 million. So let's see the profit now. What is the profit is going to do? Yay, they are increasing exponentially. They are going to rake in because they're going to do more miles, means their fixed cost and the landing and servicing fee, they are staying the same mostly because of the fixed elements. So only the variable element is changing, but it's not in line with your sales revenue. So therefore, your profit is going to go up. So let's look at the the profit per mile numbers here. 131, 33, 186, 75, so on, so on, so it goes up. Now, if I go to 10,000 miles, that's going to even more than 200 pounds. So this is how the budgeting works. In the exam, they may give you a question like this way. Be careful when it comes to flexing your budget. You can only flex the variable and the sales revenue, not the fixed cost. Fixed costs are supposed to be fixed. If you have a semi-variable, please remember only flex the variable element. This variable element of 40 pounds per mile is the only one going to change, guys. Nothing more, nothing less. Okay.